Hi, I'm Pattu from FreeFinCal, and in this video, let's talk about how to decide on the asset allocation for a financial goal. That is, how to decide how much I should invest in equity, how much I should invest in fixed income, if my goal is or my need is 2 years away, 7 years away, 10 years away, 15 years away, and so on. Before I begin, this is of course the FreeFinCal website. The main menu contains some of the flagship tools, but I want to draw your attention to the YouTube channel. If you go to the main page of the YouTube channel, of course you can go to the main page by clicking on the FreeFinCal link right below this video. There is actually a search bar here, so there are something like 200 plus videos here. If you type for any keyword within this, you can see that I've already made a video on what is asset allocation. I've already made a video on what is rebalancing and so on. There are many other videos which talk about risk reduction and so on. Please search for this. People say, make a video on this, make a video on that. Have you talked about this? Please search for this, and if you don't find it, please ask me. I mean, I would appreciate you searching for this, because it will just take about a couple of minutes. And if it's not there, if you have a particular problem in investing other than where to invest, you can, and I have not talked about it, please let me know in the comments and I'll be happy to address it. So in this video, I'm going to talk about asset allocation, that is how much to invest where. So I made a table for our easy understanding here. And so in this, I've just said after how many years do you need the money, after 1 year, after 2 years, after 10 years, and so on. And then how much to invest where. So I've taken 4 asset classes: equity, as in direct equity, investing in shares or equity mutual funds; fixed income, as in SB account, recurring deposit, fixed deposit, debt mutual funds, bonds, EPF, VPF, PPF, the debt mutual funds of NPS, and so on. Gold as in buying physical gold or tracking gold via ETFs and gold bonds. But for this video, we will not talk about gold or real estate. Real estate can be direct buying and selling or via real estate investment trusts. Again, like I said, we will not consider gold allocations and real estate allocation in this video, but as an asset class, it is one. And if you are comfortable with, and if you know what you're doing with these asset classes, you can include them for your plans. But I cannot comment on both of them. I cannot comment on real estate, and I would never touch it for investing. Gold is an unproductive way of investing, and it's just too risky and the returns are too low. Therefore, there's no need for gold in my opinion. Again, I have talked about all these in videos. You can go and search for them. Search for real estate, search for gold. So this is the actual asset allocation, how much to invest where. We will talk about that row by row. And then I have, unfortunately, to decide the asset allocation, we need a portfolio return, because the asset allocation depends on the investment duration and also the risk you can take and the risk that the goal needs to be taken for it to be accomplished. So how much return can I expect? I have set the equity return at a constant 10% post-tax. I strongly advise you to do the same. Do not expect more. If you expect more, you have to manage your portfolio more and you will be disappointed more. If you expect less, the chances of it getting accomplished with minimal management is pretty high, and that is what we should be aiming for as normal, ordinary investors. If you're an expert, please, this video is not for you. Don't look at all these. You can do what you want. You can have 100% equity for money you need after 2 weeks. That's up to you. We're not going to talk about that. Fixed income, for a short duration, I've assumed 6% returns from liquid funds, overnight funds kind of thing, or very safe short-term FDs. For slightly longer goals, I've taken a fixed 7% return after tax again. 6% is possible with mutual funds like overnight mutual funds, arbitrage funds, or liquid funds. 5 to 6% is possible. If you want, you can use things like fixed deposits. If you're in a favorable tax slab and you can get 7% post-tax with a fixed deposit and lock in, you can do it on an RD, you can do it. It's fantastic. You can use arbitrage funds as fixed income instruments. Please search for a video on arbitrage funds. again, that's post-tax is reasonably possible. Debt funds also can be used, like ultra short term can be used, of course, but there are credit risk issues and so on, so you need to understand what's happening. But I think 7% is quite reasonable for fixed income. I have set the gold and real estate returns to be 0 because I'm not anyway talking about it. So we'll take it year by year. So for money that I need after 1 year, I have said stay away from equity because it's too risky. Stick to 100% fixed income. Therefore, the portfolio return is 6% because it's the expected return because everything is fully fixed income. Similarly, for 2-year goals, 3-year goals, 4-year goals, and 5-year goals, up to 5 years, I recommend nothing in equity. There is a video again I've on how much to invest or how much equity can I have in my portfolio. Check that. I have given you reasons why I say that. Even for a 6-year goal, I've just said add a little bit of equity, 10%, little bit like a seasoning, for and then gradually making it 20%, 30%, 40%, and I even kept it only 50% for the 12 to 13-year goals. Of course, these are all for beginners, for normal retail investors who don't want to manage their money every day. And so on. So the minimal if you want minimal management, then you should pay the price for it. Don't put in too much money in equity; it's too risky. The market crashes, you will get scared and pull out and so on. Don't do all that. For 15-year goals and above, you can have 60% fixed equity initially for the first 3 years. I'll talk about that. After that, you can. For anything below that, I think 60% is okay, but I would recommend if you're a beginner, start with something lower. So if you choose equity as 30%, the fixed income will become 7%. So let's go for, let's talk about, let's say year 7. For a 7-year goal, I would recommend 10% equity and 90% fixed income. So we can calculate the expected portfolio return in a very simple manner. We say that this is the 10% weight into the 10% return plus 90% weight into 7% return, and that's the approximate return. That's how all these expected returns are being calculated using the same idea. It's just a weights, approximate return, right? Now, what you should keep in mind is, let us say you start investing for a 7-year goal today. After 1 year, it will become a 6-year goal. After 1 more year, it will become a 5-year goal, then 4-year goal, 3-year goal, 2-year goal, and 1-year goal. So please recognize this 10% equity and 90% equity should not be your fixed asset allocation. This is the initial asset allocation. As it becomes, you can hold the 10% equity for 1 more year, but the moment you are 5 years away from the goal, switch it all into fixed income and remain in fixed income throughout. That is so a stepwise reduction in equity works very well. I have another video on that, how to reduce risk in your portfolio. Have a look at that. So again, let's consider this. Let's take a 15-year goal. Let's say a goal is 15 years away. Today it's 15 years away. After 1 year, reduce it to 50%. Hold it for a couple of years. Then reduce it to 40% for a couple of years. Then to 30%, 10, 20, 0, and then hold it to 0. So as the deadline approaches, you can go step by step and so on. That stepwise reduction works very well. And if you use the Robo Advisory template, I hope we can still show you the Robo Advisory template. So if you go to the main menu, you can see this free Robo Advisory. Click on this, and you will be able to do all these calculations in an automated manner. Sorry. So this is the asset allocation map that I strongly request every DIY investor to make. It's just simple math. It's just common sense, nothing more than that. I've said. Just make this map and you will feel so much more stronger, so much more confident that you have a plan. It's not, people are so worried about where should I invest, how much return can I get. They don't have a plan. First have a plan, and the plan starts with what is my asset allocation and how is my asset allocation going to change year on year. So if I start from a 14-year goal, my asset allocation is going to decrease in this manner, and I already have that kind of a map ready-made. So please do this for your own goals and make sure you're complying with it. And please recognize that, so let's say you start with 50% equity for a 14-year goal, and after 1 year, the asset allocation is different from 50-50 because of market movements. You have to reset it back to 50-50, and that's called rebalancing. So every year you have to rebalance as well as reduce your equity allocation step by step. You should do both, and these will take you, like, this kind of management will take you about 30 minutes once a year. 30 minutes once a year, that's all. So I think that's what I have to say. If you have any questions on asset allocation and on these kind of strategies, please let me know. Please check out the videos on rebalancing and how to reduce risk. I will try to leave the links in the description box. And if you have any questions, do let me know. Thank you as always for watching. Bye bye.